Hey everyone, thanks for watching. It is Thursday, and as part of our expert series, you know what Thursday means. That means we bring back Jonathon Twomley. How you doing, sir?
I'm great, Michael. How are you?
I'm doing very, very well. Looks like we got three topics today we want to make sure we hit for folks. We're going to talk about the unemployment claims and unemployment in general. That's something you and I get to talk about every Thursday because it comes out Thursday morning. Then we can talk about this headline. I don't know if you've seen it, but apparently the recession is over. So we should talk about that and see where if there's smoke, there's fire, or what people are saying. And then finally, because this is a real estate channel, we've got to come back and talk about multifamily and single families. Does that sound like a plan?
Absolutely.
Excellent. So why don't we jump into unemployment? As I remember the numbers that I read this morning, it was disappointing. I think it was 1.51 million new claims on an expectation of 1.3. It was down.
Actually, 1.2 was the consensus.
Yeah, 1.2. It was down 58,000 week on week, which again was a disappointment. They were looking for a couple 100,000. Then the more important, now that we are into this, they wanted continuing claims to break below 20 million, and they did not. They stayed at 20.5, down 62,000 week on week. So what do you make of all this? It's and again, it's 13th week we're over 1 million claims, and the peak of 2009 was 606,000. It's crazy.
So the trend is in the quote unquote right direction because the new claims are continuing to fall.
True.
But I think we've gotten so this is a good. I talk about cognitive biases a lot when I teach about investing, and this is a great example of a cognitive bias where called an anchor. Anchoring is when you focus on a particular piece of data, and then that affects how you view other data. So that first massive claim when the record high before was 660,000 and it was millions. Everybody was like, "Oh my God, this is horrible." But now they've anchored onto that incredible piece of data, and every single week it's less, and they're like, "Oh, things are moving in the right direction." Whereas the real thing you should be looking, and if the data is the way that you look at the chart, if it's clipped, so you're only seeing the beginning is the start of this 3 months ago, then it looks like, oh wow, things are really getting better. But you have to look at the data the right way. You have to look at the data compared to where it has been historically, and compared to that, we're still almost triple what the previous high was.
Yeah.
Not to mention that this is cumulative. So it's week after week after week. We're literally, the reason that it is falling is because we're running out of people to lay off, right? And no, I mean seriously, think about it. Like all of the businesses that shut down because of COVID have shut down, right? So there aren't like new businesses shutting down because of that, except that maybe we might see something with second wave in some states. It's looking like, I was reading today that Florida looks like it's going to be the new epicenter. And so you may see it spiking back up again as things have to, maybe be forced back into lockdown, or if it's not locked down, but people are just like, hey, I'm not going out to bars or whatever. So there's that. And I think also what we're seeing now too, because basically everything is reopened. Even, New York City was the last place to reopen. We just got word that we can go into phase 2 on Monday, which means that we can have outdoor dining. I can finally get a haircut, like all kinds of stuff, which is great. And we've really flattened the curve here, but it's likely to just spark up again if people are not super careful. So, and I think it's going to make people cautious. We're seeing the decline in the number of businesses that are the COVID related stuff. Now I think what we're into is the secondary knock-on effects.
Yes, that's what I've been talking about and very scared about. It's that second wave, right? Drop a pebble in. First wave is retail, restaurants. And I've always been concerned about that second wave, because the second wave is, generally speaking, I mean, no biases, higher paying jobs, generally speaking, and more structural, right? You can see retail and restaurants hiring back when they reopen. But this second order derivative, you have companies now are looking at their headcount going, ooh, I bet I can use 10% less people. Oh, this work from home thing's kind of cool. And I mean, it's going to be painful for a long time.
There's the structural problem. And then there's also there are people like my wife, for instance, who got laid off because she's in the tourism business. She got laid off because their business just went to zero. But now they all just got an email saying effectively, like, we're not sure we're ever going to be able to reopen. Because this, this is going to last a lot longer than, all of the, they had orders for groups to come and visit New York City in August, and they've all been pushed back to the end of the year. And so who knows what's going to happen. And I think you're going to see a lot of that. I mean, there was an article in the Wall Street Journal yesterday or the day before about how something like 1/5 of New York City hotels will probably never reopen. So 1/5 of New York City hotels will probably not survive the drop off in tourism. And that's even though right now, and I'm very surprised at this because I'm not really seeing people around, but apparently New York City hotels are now back up to 50% capacity, right?
Really?
I mean, they're back up to 50% occupancy.
Huh.
Although, as someone astutely pointed out, they're probably offering a steep discount so that they're not getting 50% of the revenue that they would normally get, but they're still at, they're at 50. So people are coming back to the hotels, but even though that's happening,
interesting.
You can't operate a hotel at 50% occupancy night after night. Like, so there are going to be hotels that just are going to go out of business because of this. There's going to be, now the talk is, okay, what are we going to do with all these hotels? Are they going to become offices? Right? Yeah. Are they going to become like, probably, they're going to be converted to multifamily or something because
studios
what else are you
or
do
whatever.
So, which will then have an effect on, there's already a supply glut of multifamily in New York City because people just for the last 10 years just been building it like crazy, and rents have fallen because of the combination of oversupply and now less demand. And if they just convert all that stuff to multifamily too, it could be good for the city. Frankly, the rent is too damn high, right? I mean, as we
that's true.
heard a long time ago, so it may be good for the city to have more affordable rents, but nevertheless, that's going to have a big economic impact. So that's I think what we're.
So when we go back to unemployment, right? That does have an effect on. It is the consumer, right? Because what I track always is what's going on with the consumer, what's going on with the consumer. And, I think there was a lot of initial belief that, it will be at least somewhat of a V-shaped recovery in employment, right? Lay a bunch of people off, hit the bottom, come back. And while the trend is still down, you can still say the trend is intact because this week was smaller than last week. It feels, and I haven't done the math, I probably could do it in my head, but it feels like the trend is slowing, right?
Yeah, the trend of unemployment, of new claims, yes.
Yeah.
It is slowing.
The improvement of the trend is slowing, right? So we're getting, it's just, that's concerning to me.
Yeah, it's so, I mean, look, we had, there was some good news on the economic growth front, right? Which is natural, which is just, we would expect, like, you shut the economy down, economic activity drops, you flip the switch back on, it goes back up. Like that's what we expected to happen. So consumer spending jumped by a huge amount, month over month. So there are people out there saying, hey, look, we were right, it's going to be a V-shaped recovery. And, but a lot of that is people they've been, like we talked about before, they've been cooped up for weeks or months, and now they have the chance to go out and do stuff, and they're obviously going to spend a lot of money. And they've also been receiving government stimulus money, which they haven't been able to spend. And so now, they're out there spending. So that makes perfect sense. But the real issue is like, well, how far does it go? Is it going to go all the way back right up to where it was when this whole thing started? And I think that's just highly unlikely because of the restrictions that are still in place, people's anxiety about what's going on, and a host of other reasons. Like just anecdotally, there was a report that the Bellagio in Las Vegas, which has reopened, had one of their kitchen staff test positive for COVID. So that resulted in the kitchen having to be shut down and cleansed, and everybody getting tested. And then, so what effect does that kind of stuff have? I mean, obviously there's an immediate effect which is that all those restaurant reservations that they had that night got canceled, right? All the room service, whatever it was, that didn't happen. And if this gets multiplied across hotels across the country, not to mention like there's the bad press of like, oh, go to the Bellagio, you might get sick, right? I mean,
exactly.
It's all of these things are going to keep economic activity depressed for some time. So I think the expectation that we're just going to bounce back very quickly, I think is just unrealistic. No matter how good the temporary economic news is, and we've talked about this before, like, you bounce back, 20% like consumer spending did, but it was off by 30%. It means you're still down, more than 10, right? Yeah. So,
we'll give a good example here in a minute, but I want to hit unemployment one more time because one of the things that I see being that's going to need to be decided pretty quickly is, does the federal government extend the unemployment benefit of $600? I think there was a general belief, at least in the Senate, that they were not going to extend it after the, I'll call it surprise May report, right, where they added 2.5 million jobs. I'm hoping now they're looking at these weekly numbers and going, something was amiss. We're not revalidating the May data. We really need to help people. And because if they don't, man, this thing can get really, really ugly really, really quickly, and is my big fear.
Yeah, I mean, I've said, we've talked about it before on the show, that I think so. There's going to be something. I think something will emerge, probably at the last minute, very slapped together, the same kind of like, like terrible sausage that they make when they do things really quickly, so I think we're going to get another package like that. But I would be very surprised if it is as generous as it was initially. And I think the only reason it was so generous in the first place was because it was thought, okay, well, this is like a 2-month problem. We'll shut down for 2 months and we'll be fine. So we can be really generous for 2 months. But I think if you had said at the outset, like, this is going to last for 18 months, I don't think there would have been any consensus to pay people an extra $600 a week for a year and a half, right? So, so I think that we're going to get that pushback on this. And I haven't seen. I mean, the last thing I saw out of the administration was that they were opposed to continuing the benefit, but that was a couple of weeks ago. So I haven't seen anything, any revised position that they've taken since then to ameliorate that or soften that opposition. But it's still a big black hole right now, and I think, like, as an investor, that should give you pause. Like, if you don't know, you shouldn't be moving forward and saying, oh yeah, Congress is going to throw extra money at this problem. Or, like, as I've seen some people say, oh, well, if Trump's numbers continue to decline, he's going to want to, bribe people into supporting him. So he's going to, dole out the federal funds. But I don't know if that's a certainty. So,
well, I don't know if you saw Fed Powell. You probably saw it, or maybe you read about it. I think it was Tuesday this week. He came as close as I've ever seen a Fed chair to telling Congress to do something. Right? Usually they try to stay separate. He was like, right. I'm doing all I can, people. Mm-hmm. Get off your ass and do something, because I can't do it alone. That was basically what he said without saying it.
Yeah. Well, listen, I mean, there's a lot of issues out there. We've talked a lot about unemployment, obviously, and the effect that has on spending. But I mean, we haven't talked for a while about the corporate debt issue, right? Because that is still a huge issue that just hasn't been really discussed much recently, as people have been focused so much on COVID and just unemployment and things like that. But there are a lot of companies that were zombies before this started, that were surviving basically on cheap debt, and then they were not even using the cheap debt to like fix their problems. They were just buying shares and keeping their stock prices up when they should have been heading in the other direction, right? So they're basically borrowing money to prop up stock prices without and just not and kicking the can down the road about, oh, well, what happens when the economy changes and now we can't pay this debt back and all that money we just threw down the drain, but we still owe it. You know, I guess their attitude is like, oh, we'll go into bankruptcy and screw the bondholders. That's fine. We do, you know, that's what you do. Maybe that's how corporate America thinks these days. But
maybe
the you know, but those companies are you know, continuing to survive on cheap debt. The Fed is now buying a lot of those bonds.
Yeah, I was going to ask you about that, given that we got here. What do you think about their tweak or change going from buying ETFs to now? I call it picking winners and losers, which disgusts me to no end. That Powell's going to be now frankly picking winners and losers because I'll buy your debt and not yours.
Are they? I don't know how they're structuring this. Are they just buying across the board, or are they literally doing that? Or are they just trying to buy what's in the most trouble they're buying, or what's the decision-making process?
They're being very vague on that because I think they want to give themselves the greatest options. Yeah. But they very clearly said we're going to stop buying ETFs and we're going to buy individual corporate bonds. The only rule I have seen is pre-health event you had to be better than negative triple Bs. So you couldn't have been junk at the time of this event, but you can be junk now, which, they call the fallen angels. I mean, it scares me.
Well, listen, as someone who has a lot of money invested in bonds, I mean, like on the one hand, it benefits me, but I agree with you on the larger sort of philosophical point. Like capitalism doesn't work if companies are not allowed to go out of business.
Where is capital destruction? It is part of the process.
Yeah, and these companies should not have been allowed to borrow money in the first place. They should have been allowed to go out of business, especially if you think about it. Like when would have been a better time for those companies to be restructured than when the economy was going gangbusters and they could have, and all the employees that had to be restructured could have easily found new jobs. Like that would have been a good time for that to happen. But of course, it wasn't permitted to happen. The banks were, and investment bankers who were issuing these bond issuances were like greedy about it. Like nobody was, and the shareholders were like, okay, great, you're going to buy my shares and prop up the stock price is great. It's a big fraudulent Ponzi scheme, essentially, that benefits only a very few people, but it really does major destruction to the economy. And then when these companies are not allowed to be able to go out of business and get restructured, it creates a long-term drag on growth, and that's what we're going to see. I saw in connection with this, I saw a very interesting comment this morning in reading Seeking Alpha that was talking about how in the 1990s the U.S. was really like beating its chest and raking Japan over the coals for not allowing Japanese companies to fail, right? And they were doing everything they could, buying corporate bonds and buying, corporate stocks. The Bank of Japan was doing this in an effort to not allow these companies, these zombie companies, to go under. And the U.S. was like, hey, look at us. We're much better than our brand of capitalism is much better than yours because we allow creative destruction. Now we're doing exactly the same thing.
Yeah, we are.
And we're going to get the same result, which is, decades of really slow growth and constrained by public and private debt. And it's just not a way to run things,
Yeah, totally agree. So let's switch gears to point number 2. I don't know if you've heard this. Based on retail sales, I think it was this week, Monday or Tuesday, the recession is over.
The recession is over.
Yeah, the recession is over. Retail sales, if I remember the number right, was up 17.7%. I always kind of break that down. And the number that struck me was clothing. I don't know if you saw the kind of sub breakdown.
I didn't see the breakdown, no.
It was up 188% clothing month on month. But okay, let's do the math, folks. This is what drives me crazy. April clothing down 80%. Okay. So now let's assume clothing was up 200%. Just makes the math easier. It goes from 20, right? So 100 down 80% to 20. Then you have 200% growth from 20 to 60. You're still down 40%, folks. I mean, what are we celebrating here? It's crazy.
Oh, look, it's better than it going the other direction.
Well, I guess.
But but the other thing is that you have to also consider too, this number is a snapshot. It's not a trend yet, right?
Yep,
so
agreed.
It could be just pent up demand. It could be, everybody's like, oh, I gotta, I can get out now. I got to go buy my summer fashions, right? And my summer stuff. So it's not surprising, but I mean, the fact that you were still down 20% or whatever that number works out to is not good. But technically speaking, now people are calling an end to the recession because we have growth again. And as you and I have said, like pretty much week after week after week for the last 3 months, people are going to be out there shouting about the great data, about the V-shaped recovery, but that's not, it's premature to say that. And it's off the low numbers, it's off the low base.
Well, it's just not accurate. It's at least misleading, right? It may be mathematically correct, but you're interpreting mathematically correct data incorrectly, I guess I would say.
Well, not just that, but it's also like, I mean, just like in the last recession, right? I mean, the last recession technically ended long before people felt like it was over.
For sure.
Right? And that's the way it works. Like, because it's a technical definition, right? Either if you have 2 quarters of negative growth, you have a recession, right? So you can have a very shallow recession that nobody would even notice because you could be off 2 quarters by 0.01%, and you'd technically have a recession, and but nobody would even notice. Or you could have, something that's like really, really bad, and but then you have a rebound to growth pretty quickly. Like, in the last recession, I mean, it was long, it was still like almost 2 years, but still, like when economic growth began again, and then the recession was over, but people didn't perceive it that way because things were really ugly out there. And I think that's right now we're not seeing the ugliness of it yet because it's been so short. Now people are going back to work. A lot of people are really convinced, like, we're just going to snap back to where we were. There are people who were convinced that like the whole thing was a hoax anyway. It was all made up. So therefore, since there were no issues before, there are going to be no issues after. It's like we just called a timeout for a while. It's just people are not going to just go back. As we've said before, there are the businesses that didn't survive. There are businesses that are still going to struggle, like the whole tourism industry, which is a huge part of the economy, right? I mean, we've got cities that are basic, like Las Vegas has no economy other than tourism, right? Parts of Florida have basically no economy other than tourism.
Yeah, New Orleans, maybe, yeah.
New Orleans, plus think about like every, summer-side resort that basically where people make all their money in 3 months and then they're on vacation for the rest of the year.
Yeah.
They miss those 3 months this year, or even they miss 1 month of the 3.
Yeah.
They're in serious trouble. So the idea that this is sort of constant, it's like we just call the timeout and it's all good after that is not realistic.
So I'm curious, right? So let's talk about this recession thing. So it's no question we're in a recession now. It's the first recession I'm aware of that we're calling it while in it, because Q1 was down 5% or 5.1 or whatever it was. Q2 will obviously be negative, but Q3 will be positive because it's coming off of a low basis, right? So this will be a 2 recession. That's true,
although
right? Mathematically.
Well, unless I mean, it could, like in terms of the technical definition of a recession. Now that doesn't stop us from having a double dip. I actually saw, so the first time today I saw a really interesting, like there's all this debate about what's the shape of the recovery going to be. Is it going to be
what letter? Yeah.
U-shaped, square root, L-shaped. So I saw a brand new one today I had never seen before, which is shark tooth. It's going to be like up and down and up and down, but going in a trend, up and down and up. So I guess it's sort of like a shark leaning to the side, smiling.
I could see that, yeah.
Which I think makes a lot of sense actually, because there's going to be, it's going to be choppy on the back up, and it's going to take a long time to get back to where we were. So as it is.
Go ahead. Sorry.
As it is. Oh. as it is right now, what they're predicting is that end of the year GDP is going to be lower than a year before, right? So it's going to be lower than 2019, and we may not even get back to 2019 in 2021. Yeah. So, and I think those reports are kind of optimistic. I mean, if we have just a large, like if we get into like what you were talking about before, that second layer of that middle management layer, people who get laid off because they can't that's like the companies resist firing those people because that's where all of like the institutional knowledge of the business resides, right?
Yes.
So if you let those people go, you can't replace it. And you've got to, then ramping back up is really difficult with new hires. You know, the frontline people who are at the cashiers and stuff, I mean, you can train those people up very fast if you need to hire new people, but that mid-level people, that they'll keep those people on payroll even if there's no business, because they really have to, if they want to ramp up again. But at some point they make a decision like, hey, we're not ramping up. Now we've got to cut further.
Yeah.
If we get into that second layer, that's when things get really bad. And those people are not going to be able to get jobs quickly again. It's going to take a long time.
That's my fear right there.
Yeah.
So one of the things that I have seen, and we can continue this, is I actually think it's pretty clear that we're going to have what I call a K-shaped recovery, right? So we had a quick down, right? The letter K. And then what I think is going to happen is we are going to have winners and losers this time, right? We are going to have people who don't lose their jobs, who are rich, if you want to call it rich, meaning they own assets, right? Whether that be stocks or real estate. And again, because the Treasury or the Fed has come in, and you don't want to bet against the Fed is going to take care of people who own assets and stay employed. So that's the up leg of the K. And then the down leg is we are going to have more and more people on government assistance that are going to be hurt. They're going to be structurally unemployed for a long time. This job recovery will be the longest in my adult life, right? The dot-com crash, that was like 3 to 4 quarters. The Great Recession was like 6. This really could be 8 to 10, looking out in the future. So I think it's going to be a K-shaped recovery, because I think the Fed is inadvertently or on purpose picking winners and losers. If you own assets, you're going to win.
Yeah, I mean, part of it is that like the Fed doesn't know what else to do, right? I mean,
that's true.
It's like, and every time you dump a bunch of money, depends on who you dump the money on. I still think what they should have done was just issue checks to individual people and leave it at that.
Totally agree.
And not, because it wasn't a liquidity crisis. It wasn't a liquidity crisis in the sense that like people couldn't borrow money. It was a liquidity crisis for average people who now suddenly had no income, right? So that would have been a better way to go about doing stuff. But what they did though instead was, just lower interest rates, which of course is going to translate into higher asset prices at some point. But here's the kicker though. Where I disagree with you a little bit is that if you might see if you've got people who are dependent on cash flowing assets to live on, those people are, and I'm talking about real estate specifically, like those people may find that, their asset prices have gone up because there's all this free money and floating around and investors have money, but their cash flow is down.
True.
Because their tenants can't pay rent, right? So that's, I think, just a weird situation to be in. So you might start seeing people selling assets to raise cash because they're not making money because their tenants are not, they've got to liquidate or be foreclosed on. So I think there's, it always comes down to jobs, right? I mean, everything is all about jobs. It's all about, do people have money in their pocket to spend on rent, on buying new clothing, buying cars, buying food? And if they don't, then the whole thing just contracts. So, I mean,
well, let's switch gears to number 3. And actually, I'll start this off with something you may not have seen. It looks like Grant Cardone is celebrating paying his syndicate or paying his investors. I don't know if you saw that. He sent out $6.3 million in distributions on the 15th, so a couple of days ago. And of course, he's made a big splash because, like many syndicators, he made the great business move of postponing or delaying or whatever the right word is for a couple of months. He then reported collections over 90% several months in a row. It looks like he must have done that again in June. So he's confident enough to send out, significant distributions this month. And I was curious, because you're in the market, are other syndicators now sending distributions after 3 months of 90%, or are more people holding back?
So everybody stopped paying at the beginning.
Yes.
And they suspended. But yes, I'm seeing this. I'm seeing, since the results have been good so far, what I'm hearing from other people is that they are resuming distributions.
Okay, good.
Because they're like, well, we don't really have any justification for holding on to this much cash,
Yeah.
but they are reserving, right? They're still reserving against, the end of this
Okay.
program, right? So they haven't gone back to just saying, oh, we owe you all this money, so we're
Right.
going to catch up to everything, but they are resuming distributions with high reserves in place, which I think is the right thing to do. I mean,
Yeah.
if you feel adequately reserved, there's no reason to not but that if but you have to be smart and be thinking about what happens next month, right?
Yeah. So what I'm hearing you say is it was a wise business decision not to do that 2 months ago for everyone. Then what you did is you build a bigger pool of reserves, right? You maybe realized, hey, that might not be deep enough. So now it's deep enough. And you're like, damn, third month in a row, 90% collection or whatever it is. We need having too much cash is a problem. We need to distribute this to our investor. That's kind of what happened.
Yeah.
Okay. So, all right. Very cool.
Yeah. So this is I'm seeing this across the board. So
all right, that's good.
On this rent collections issue, though, again, we still don't really know. There's some evidence that rent is being paid by credit card, right? So
really,
yeah, online payments are way up over where they were. Now, obviously, some of this is because everyone is at home, right? And it's social distancing and contactless everything. So some of it has to be related to that. And I'm sure some of those people who are paying by credit card are then paying off the credit card immediately, right? But
not everybody.
Problem is we don't know, right? We don't know how many people are paying by credit card because they have to, because they can't, they don't have the cash. And then again, we have next month this looming deadline of just a few more weeks of these. And I think a lot of people have been banking that money. There's also, I was reading today that people have been using that money to pay down credit card debt. I mean, people are like deleveraging, like, because they're scared, right? They're trying to get their personal balance sheets in order because they don't know where this is going. So, we'll see. We just don't know. That's the problem. We still just don't really know where this is.
Yeah. And then the closing topic is one that's going to be interesting because this is the whole disconnect, or basically where our experiences kind of complement each other. As I'm in the single family market and you're in the multifamily market. I don't know if you've seen it, but there's been a lot of great news about single families here recently. Mortgage apps are way up. New construction beat expectations. I reported Sunday a freaking scary number about my local MSA, or out of the MLS, where listings are down 30% year on year, but demand is now up 50%, right? So if that continues, and that could have been a 1 week aberration, but it was so scary and so unusual that it only points to higher prices, at least below the median. We are seeing in my market a divergent between jumbo loans and conforming loans, which just goes back to the government buying all the non-jumbo loans they can get their hands on, is what it sounds like. So lending's up, has 12 weeks in a row. This week was reported 11-year high. It's 25% higher than pre-crisis. I mean, just crazy good numbers in the single family market. So I'm wondering what happens to multifamily.
Yeah. I mean, so it's interesting, like literally within one day of another, I saw on, I think it was the multi-housing news website, but I don't remember which website it was, but I remember it was the same website. So 2 days in a row, two conflicting reports. One was an analysis that was arguing that because of COVID, home ownership is going to decline further because people just won't have money to buy homes, right? They're saying in every recession, that's what happens. Home ownership declines, a bit because people just don't have, they don't have the money for down payments, or they're anxious, like they don't want to spend, right? They're they're banking the cash. Cause like, I don't know what's going to happen to my job. I might need that money to live on. So I'm not going to use it as a down payment. So that article was saying this is going to be good for multifamily. It's not, they were saying this isn't like, you shouldn't be clinking champagne glasses, but this is going to help the multifamily industry weather the storm. It'll help weather the storm, right? So, but then the very next day, what in the same publication, and they were actually linked together, these two articles, was, the talk about the rebound in single family home purchases, right? So which trend is going to win, right? We don't know yet. And maybe because it's early, the trends, those things are conflicting with each other. We don't know which direction it's going to go.
Yeah.
You yourself, said last week that, what you think is going to happen is that the higher prices will pull all this additional supply onto the market and cause prices down again. So, which would be good for everybody, but how that plays out for multifamily, still not clear. And we still have, all this obviously is being driven by, the two conflicting trends of people have less money, but people who have money, maybe they want to get out of an apartment or they want to get out of a city and move to the suburbs, so we don't know which of those.
Yeah. Well, I'll tell you what, I like looking at the crystal ball and trying to put it out there, because I'm putting money to work all the time. I actually think in this recession, because it's not housing related, we are actually going to see a jump in housing ownership. It'll go higher. It won't go higher by a lot, but I just think there's been people that historically the last decade delayed home ownership, right? You can blame the millennials, right, who got life started later than future or past generations. There's been people that wanted to live in the Class A apartment because of all the amenities and all of that thing. But now, again, everybody remembers the last crisis. And here we go again. Space is good. And if your employer says you don't have to live in the city and you can have a mortgage payment in the suburbs that is less than rent, and you can have a front and backyard and a garage for your cars, I'm going to see homeownership's going to go up by a 1% or 2%. That's my prediction out of this. I don't know if you see it any different.
Interesting. No, I think that's persuasive. I just honestly don't have, I can't really say. So, sure. But I think that there's some solid reasoning behind that. And I think it also may, you're talking the overall, right?
Yeah.
Obviously market to market is going to change.
No, that was the US.
Yeah, the overall. I just, this is slightly off the topic, but I was reminded about this last week. After we talked, there was a Sam Zell did a presentation, and unfortunately I recorded it, but the sound didn't come out clearly enough to hear it. And but one of the things that he was saying, one of the questions he was asked was, "What do you think about this work from home trend? What is this going to how do you see this playing out?" Mm-hmm. And he said, essentially, meh. He said, the problem is that it's one thing to manage a team that's already in place remotely. Once the team has come, they've been working together for a long time in person. They know how to communicate with each other. They know how to work together. They all know what their roles are. Managing a team remotely like that is one thing, but putting a team together, hiring new people and bringing them into a virtual office is something else. And then there's that, that oversight problem. You don't know if people are really doing work or not. Right. With a team that you have in place that you trust, that they are, but with new people, you don't. So he thought it'll have some effect on the margins.
That's a good point.
But he doesn't really see this at the end of the office or anything like that, which I thought made a lot of sense.
Yeah, that does make sense.
Yeah. And I think the thing that's interesting about listening to Sam Zell, listen, the guy's been in the business for 60 years. Right?
Yeah, that's very true.
A lot of stuff. And I think he has a very long view, which just, he's seen a lot of noise in the market.
Yes.
Over the years, right? And so I think that enables him to say, okay, everyone's paying attention to this thing right now.
Yeah, in the moment, yeah.
In the moment, but extrapolating that out into the future forever is not a good idea. So I think it was very interesting listening to him.
Yeah, and I think in your group, which again, people need to be a part of. If you're not, we'll have you list the name again in a minute. Bless you.
Excuse me.
I think you sent out a summary, because I remember reading kind of your thoughts on it and asking a question in your group, which I thought was awesome. And basically what I took from that in a sentence or two is, he's not looking to aggressively buy. Price discovery hasn't happened yet. There's been no pain. That's kind of what he said.
Yeah, that was a big point of his talk, and it's always good to hear someone like him say the same thing that you and I have been saying, right? It makes,
makes me feel better. Yeah.
Yeah, exactly. You can't compare myself to a guy like that,
no.
But it's good to, when someone like that validates what you're thinking,
For sure.
it makes you feel like you're okay, you're on the right track with stuff. And so, what he had said was exactly that. Like we just don't know where this is going yet. So therefore, it's not the time to buy. He also said, that there's no price discovery in the market right now because there's so few transactions happening, and what happened was already in the pipeline. But looking at the REITs are down by about 20% or so. And he says, historically those public markets are pretty good at reflecting reality, at least for REITs. I mean, for the rest of the stock market is going haywire right now, but the REITs have been pretty historically accurate, he says, as a measure of like where value is at the moment. So, and they were down by 20 to 25%. So he thought that's kind of where prices were now, to the extent that, transactions were happening, but transaction volume is way down because buyers are looking at that like 20% discount, and sellers are like, no, collections are great. Everything is fine. Nothing to worry about, nothing to see here. Like, just keep on buying. So, we have that disconnect in the market where not a lot is happening at the moment.
Yeah, man, another exciting week. Please give your Facebook group one more time. People need to register for.
So the Facebook group is called Multifamily Investment Community, and we will hit 10,000 members this week. So
that's awesome.
It'd be great if you join and help us push us over the edge of 10,000.
Yeah. Again, I'm in there. Jonathon does a great job of moderating, making sure the content's right. It doesn't get blasted with a bunch of nonsense. So I appreciate that. And then you also have something you're working on called the Launchpad. Why don't we talk about that? Because you're putting a lot of work there.
Oh yeah, absolutely. So I do also, in addition to running the free group where, I give out lots of advice and share my thoughts for free. I do have a paid membership group called Multifamily Launchpad, which, if you really want to dig into learning how to buy multifamily real estate, that's the place to be. You've got, an incredible suite of materials for you, everything you really need to learn how to invest in multifamily, all the tools you need to do it. Plus, you get me in the group giving you real-time advice, and we do monthly calls and all kinds of stuff. So it's a great place to be if you want to learn about this. Oh, and by the way, one thing I haven't even told you about yet. Yeah. So as part of Multifamily Launchpad, I do a quarterly live event. And those have typically been here in New York City, but with COVID and everything, we've moved them online. And I'm doing, on July 11th, which is a Saturday, the future of real estate. And I'm going to have a panel of 6 guests who will be talking about the future of office, the future of co-working, the future of hotels, the future of self-storage, the future of mobile home parks, and the future of multifamily property management. So if you would like to sign up for that, just get onto my mailing list, get into my free Facebook group. It's going to be very reasonably priced for this day of like incredible, learning from experts about the future of real estate. So, what better way to spend a Saturday than learning about, all these different asset classes. So July 11th.
Yeah. So when that agenda or kind of comes through, we'll do a whole show on that, because that's the kind of stuff that people really need to look at, is understand what's coming in the future. So let's make sure we plan for that when you're ready.
Absolutely.
All right. Well, thank you very much, Jonathon. This has been a lot of fun.
Thank you.
Yep.
As always.